Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. Let's talk about Pascal's wager. Now, it's a little philosophical, but let's explore an old concept called Pascal's wager and see how this ties into the markets, as well as getting a little nerdy on how the whole process started around probability theory. So welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options and index futures. My goal is to help the next 1,000 traders become financially independent and retire early from the financial markets by providing the right tools to use, the rules to follow and the software to assist you, so that you don't make the same mistakes that I did. And from now on, I'll be your personal trading mentor to show you the way. And also, if you like what you hear today, please show your support by taking a screenshot and sharing on LinkedIn, and for bonus points, tag me in it. The links are in the description. Now then, what is Pascal's wager? Now, for the nerdy part, so the original concept behind this is actually religious in nature, in which the French philosopher and mathematician Pascal argued that a rational person should live as though God existed and seek to believe in God. Now, if God does not actually exist, such a person will have only a finite loss, some pleasures, luxuries, etc., whereas he stands to receive a infinite gain as represented by an eternity in heaven, and avoid the infinite loss, an eternity in hell. Now, keep in mind that this was the 17th century. Historically, Pascal's wager was actually groundbreaking because it charted new territory in probability theory, and it marked the first formal use of decision theory, anticipated future philosophies such as existentialism, pragmatism, and voluntarism. I'm not sure I'm pronouncing any of these right, but there we go, we'll go for it. But anyway, in layman's terms, it's a low-risk bet with potentially high upside potential. So a wager might go like this, and the wager uses the following logic: God is or God is not, and reason can't decide between the two alternatives. So if we think about a game being played using the same logic, heads or tails will turn up, for example, if we were to toss a coin. You must wager, and it's not optional that you can't wager. So with those parameters, we're going to go heads, tails, and you've got to have a wager. So let's weigh the gain of the loss, wagering that God is. Let us estimate that these two chances are: if you gain all; if you lose nothing. So let's wager. Again, I'm paraphrasing rather awkwardly, very old text and scriptures. But let's wager then without hesitation that he is, and there is an infinite happy life to gain, and the chance of gain is therefore against a finite number of chances of a loss. So what you stake is finite, and so our proposition is of infinite force. When there is a finite stake in a game where there is equal risk of gain and loss, it's infinite to gain. Whew, that's a mouthful in quite old English language, but nonetheless. So now let's try and put this into a trading context. When you place a trade, we're either going to win or lose. Again, just like the coin toss example, win or lose. We're either going to be right on our hypothesis, or we're going to be wrong on our hypothesis. So for simplicity's sake, let's also assume that we have actually got a positive expectancy strategy with on average, 3-to-1 or 1-to-3 risk to reward ratio. It's a small expectation, but nonetheless pretty standard for most strategies to have some sort of positive expectancy. We're anticipating, through research and strategy development and all the other things that go along with it, and money management, that we're going to risk 1 unit to make 3 units. And on average, that's what we're expecting to do. And I realised that in the real world, we might be anticipating to make more, but let's just try and keep it conservative. We're going to risk 1 to make 3. And I want to reason out that why people don't follow strategies and make money is because A, they don't have a strategy, and B, if they do have a strategy, they don't follow the strategy. So we're going to also assume that we have to place the trade. Again, one of the things that I am an advocate of is that we place the trade with the frequency that the strategy sets up. This is why I love rule-based trading. You either have a setup or you don't have a setup. There's little discretion involved. It's an algorithm, for want of a better description. So I'm putting the way that I trade into this example as well. So there's little or no discretion involved. We have a strategy. It's got a positive expectancy. We've got to place the trade, and win or lose, that's going to be the outcome. So if we don't place the trade, we'll never win. But if you do place the trade, you have an opportunity to win. And it's that second part that most traders don't do. If you never place the trade, you're never going to have an opportunity. And a lot of traders, they'll also try and pick and choose their opportunity through some sort of discretionary divination. But the reality is that, again, if we have all the rule-based trading system, we have a positive expectancy, and we're trying to trade with the frequency that the strategy sets up so that we can emulate the historical performance that we want, then we should be able to make profits on average over time with multiple occurrences. So, for fun, let's also layer on what we also know about our trading methods. Now, I know from my own strategies and my own experiences that we can profit on average around 50 to 60% of the time. We don't even have to win 50% of the time to make money. We can win 35, 40% of the time. Again, some strategies and traders that I know, they have, a win rate of, for example, 20% of the time, and they're making money because the reward is many multiples of the time that they lose. So you don't have to have a 50-50 coin toss. We're either going to win or lose 50% of the time. But I know from my own trading that's around 60% of the time, and it fluctuates, goes from 57 all the way up to around 64, 65% of the time. It depends on which sample set that you do, but on average, looking at many, many thousands of trades over many, many years, about 60% has been proven to be pretty stable and reliable, again, over many thousands of trades across different time frames, different time horizons, different markets. So in other words, there is a big enough data set to be statistically significant. Now, if I also assume that we focus on just one of those strategies rather than combined all of them, the strategy that I favor right now is a short-term strategy. Let's assume that it sets up once per day, which it is by design expected to do, and sometimes it may set up 3 to 5, and again, the difference being how many instruments that you monitor, and how active or inactive you want to be. So my S&P strategy family is designed to find one good setup per day. So for simplicity's sake, let's just stick with one strategy, and we're anticipating one trade a day, and we've got a positive expectation from that trade. So we're going to risk 1 unit, and we might risk many multiples of that, be rewarded many multiples of that over time on average. So again, coming back to Pascal's logic, I will always lose if I don't believe in the trade and don't put it on. So if I don't believe that the trade's going to work, then you're never going to win. You could also argue that there's lots of intangibles from not placing the trade, or trying to be selective, the impact of the emotional state of mind from missing trades or taking trades or trying to tinker with the strategy, because it's human nature that we might want to tinker under the hood, fiddle with the trade. Again, these are all bad habits from traders, but as a new trader, you feel like you've got to be doing something. But you've got a big downside and little upside as soon as you start to deviate from that strategy. But again, it comes back to, you've got to place the trade with the frequency that it sets up so that you've got an expectation of an on-average return in the future. And again, if you never place the trade, you're never going to win. If you're going to be selective with the trades, it's sod's law that you're always going to pick the ones that don't work, and you're going to watch the ones that do work, regain confidence, place the next trade, and sod's law, that's the one that's going to, bug you around. And this is often the trader's experience. You've got, with little experience or confidence, you get tripped up so many different ways. Now, coming back to my, some of my earlier comments, this is another reason why I love rule-based trading. Those rules can be codified into any good charting tool these days. And with new tools like ChatGPT coming online, you don't even have to be a coder to have things codified. If you can describe your strategy idea You can ask it to create code for your preferred charting software to start testing. I did this with my group of traders, and for fun, we did a very simplified version of one of the strategies that we like to use, and it allowed me to get a piece of code that we could put into multiple charting softwares, because everyone uses different charting softwares, and it allowed us to, at its most basic, say, does this have a positive expectancy? And yes, we can. If we use that as a starting point, then everything else that we layer on with money management and risk parameters, etc., then we should have a positive expectancy. But the point I'm getting to, is I'm sidebarring to the sidebar already, is you don't need to be a programmer to have the ability to codify something. Again, or you can tap into the knowledge base of someone who is a programmer to describe it. Again, pretty much that's what I've done for years. I'm not a programmer by any means, but I can essentially hire someone, I can describe what I want from it, and we get a base code, and then we can tweak and refine and make sure that it's working as anticipated. And then quite literally, at the click of a button, we can see if over the last 20, 30, 40 years, with however much data that you've got on any time frame that we have access to, if we just follow the rules. Again, for example, one of the strategies that I have, the main way that I trade is trend trading. So if I just bought the dips and sold the rallies in the context of a trend, with the way that I describe, and you can go back to the very first episode of this podcast to find my swing trading strategy. My intraday strategies are very similar. Bought the dips, sold the rallies, and did nothing else, didn't really think too hard. Then do I have an expectation that I should be able to make money if I follow the mechanical iteration of the strategy? And what we should see is a nice steady upward inclining equity curve. Great, that's our start of a 10. That should give you the confidence that, again, does it work? Yes, great. So going back to Pascal's wager, if I don't place the trade, I'm always going to lose. If I do place the trade, I've got an opportunity to win. If I'm selective with what I'm doing, I'm not going to emulate this positive expectancy strategy. So I've got to place the trade to have the opportunity to win, but it's on multiple occurrences over many iterations. So why wouldn't we place the trade, or why would it be selective? It's because the base question is, does it work? You don't have to take my word for it. At the click of a button, you can validate and prove any strategy to yourself. But then the only reason that why most traders might not make it work is fear. So how do we avoid the fear of losses? Again, I'm worried about, is this going to stop me out again? Again, we know we're going to get stopped out. We know we're going to have losses. So it's probably that your position size is too big for your current ability. Again, practically, you may have the means to trade the current position size that you have, but your emotional bank balance isn't there yet, because maybe during your prior learning phase, you've blown up a few accounts, you've had a horrendous trading run, and you're worried about losing further. Well, you know that the strategy works. We've validated, proven it. Again, if you need help with it, you can tap into mine. You don't have to create your own strategy. I give mine away to all my students, along with the software for you to validate it for yourself. So we've got a proven strategy that works, and we're looking to try and emulate that performance. So why wouldn't we follow that system? It's that fear again. Again, we've got the strategy, but something's still preventing us. So we need to reduce position size that would allow us to get over that mental speed bump, that mental hurdle, so that we can apply Pascal's wager. If I don't place the trade, I'm never going to win. If I'm selective with a trade, I'm probably not going to win. Maybe, maybe not. Again, it's that uncertainty. I want certainty in all my trading. So reduce the position size so that I've got the means and the ability to place the trade. And then I've got the opportunity to win with the frequency that I'm supposed to win with a positive expectancy strategy. I'm looking for a favorable on average return. So as long as we place the trade with small position size, we put the next trade on with the frequency that your strategy sets up with a positive expectancy strategy, the worst that can happen is that you risk small for a potentially large upside, which is the premise of Pascal's wager. The logic is with you to put the next trade on. The probability is with you and with our strategies to put the next trade on. So put the next trade on and give yourself the opportunity to win on average over a long period of time, over multiple occurrences, and start seeing your trading accounts grow, your retirement accounts grow, and give yourself the best opportunity because, hey, Pascal's wager. If you don't place the trade, you're never going to win. So give yourself the best opportunity to win on average consistently over time in the future. Put the trade on. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Antivesta provides educational information and does not provide financial advice.